Hello again, everyone. It is 10 o'clock a.m. Chicago time on Thursday, November 8, 2022. I'm John Kosar from Asbury Research and Asbury Investment Management, and this is your Daily 5. These are currently my 5 most important charts, data series, and Asbury Research quantitative models that I believe will be the most influential to U.S. stock market direction over the next several weeks and potentially well into the first quarter of 2023. So let's begin. Number 1, market internals. The Asbury 6 has turned negative. The last time I was with you was exactly 1 month ago on November the 8th, and we pointed out that the Asbury 6 was positive since October the 18th. So the Asbury 6 turned negative now as of 12/6, which is a couple of days ago. So during that period from 10/18 through 12/6, it coincided with a 213.6% rise in the S&P 500. Now that it's turned negative, it's indicating that the market has become internally weak. What that generally means is that the market's going to be vulnerable to moving lower, and we could see some downside here through the end of the year and potentially into the early part of next year. So for those who are familiar with me from Asbury Research or seeing me in various interviews around the internet, you know that the Asbury 6 is our own in-house metric that tells our subscribers what the day-to-day health of the market is. I built this metric, actually back-tested it. I took all of my favorite tactical tools that I've been using throughout my career, started back-testing them in sets of 3 and sets of 8. And what I found were these 6 are very good at giving me a very accurate indication of what the health of the market is day to day, which is oftentimes what you don't see if you're just trying to chase the tail of the S&P. The S&P 500 has changed in how it's traded over the past 5 years or so. You see a lot more day-to-day volatility. Wake up in the morning, it's up 60, it closes down 40, it's up 30 overnight, and then it's down the next day. It makes it very difficult to look at the S&P 500 and make an accurate determination of what condition is it in. And it also really encourages us to do the exact wrong thing at the wrong time. You're trying to chase the market up, and when you do, the next day it's down, it forces you out. So I built this so I can get a much more realistic indication of what the condition of the market is. The best metaphor that I have for this is when you go to the doctor's office and you sit down on the table on the bench, and he does those 6 tests. He checks your blood pressure, he takes your pulse, he checks your reflexes, he listens to your heart and lungs. It gives him a much more accurate indication of what your health condition is than how you looked when you walked in the door. That's what this does for the market. So you can see right now 5 of these 6 constituent metrics of the Asbury 6 are all red. They're all negative. 4 or more in one direction, it indicates a directional signal. So we had 4 or more green all the way back from October the 18th, which I'm circling here on the chart. That has flipped. That tells me that the market is now vulnerable to have a reversal from here, and that we should be looking to get our offense off the field, so to speak, and put our defense on the field. All of these dates here and all of these cells tell you that this change in the A6 has been pretty recent. Another thing I wanted to mention to you is that our CPM model, the correction protection model, you can find out more about that if you visit our website, asburyresearch.com, and go to the models tab that's across the top. You can find out more there. But our CPM is another one of our tactical models. That went to risk off as of the close yesterday. So now both tactical models are telling us that the market is vulnerable to some weakness here over the next several weeks or more. Number 2, the S&P 500 testing major overhead resistance. So here we've got our chart of the S&P 500. goes back about, it goes back, looks like to the middle of this year. And what we see here is that prior to that, when I was with you last on November the 8th, we talked about this 3,700 area right here being support in the S&P. Here's when I was with you last. This was November 8th. We talked about a bullish pattern that targeted a move to 425 as long as this 3,700 area continued to hold as support. You can see that it did. And we actually went up and hit our 4025 target, which is 5% higher than it was on the day that I saw you last. It was met on November the 15th. So just a few days later, we hit our target. Then we kind of floundered in here because we're testing a major resistance level. You've got the 200-day moving average right now at 40.41. You've got the benchmark low from back in February at 41.15. And right in the middle in black here, you've got the 2022 major downtrend. So we basically rose up to test all three of those at the very end of November and on the 1st and 2nd of December. And now we're moving back down into support. So as I look at this, the combination of us testing a major resistance level where the 2022 downtrend should logically resume if it's still valid, and this flip to negative in the Asbury 6 and to risk off on our CPM model, it's telling a story. It's telling me that for right now, the market tried to get to resistance, failed, and now internally it's starting to break down. Our first support here is 39.12. We actually tested it yesterday, the day before yesterday, and we're slightly above it today. If we break down through 39.12, our minor resistance, the minor uptrend, is still going to remain valid above the 50-day moving average, currently at 38.30. So a breakdown through 39.12 will probably take us to a test of 38.30. If we break 38.30, the minor uptrend is no longer valid. And that could clear the way for another test of this major support at 35.88, which we tested and held in June, middle of June, and then we tested it a couple of times in September and October. So that's the layout. As long as this 40.41 to 41.15 area holds, this major resistance level holds the market from going higher, the major downtrend is still intact. And that's what everybody that's been a bear is really looking at. The market had a nice rally off of the October 13th low. I think it was something like 13% rally all the way up to the D's high, and put a lot of pressure on bears, people that are expecting the market to go into recession next year, expecting poor earnings coming out, put a lot of pressure on them. They're being vindicated right now, but this is the line of demarcation that we need to watch. It's basically at 4,100. So number 3, volatility. Rising VIX is tactically negative for stocks. So here's a chart of the S&P 500 going back to the middle of the year, July 1st exactly. And then we have the VIX underneath here in blue with its 21-day moving average. I overlay a 21-day moving average over the VIX because that's Asbury Research's tactical time period. So the CBOE Volatility Index is edging above its 21-day moving average right here. The past couple of days, we've been edging above the 21-day, currently at 22.28. Note that the previous August 22nd to October 19th monthly trend of a rising VIX, right here, it coincided with an 11% decline in the S&P 500, right here. So as long as the VIX can stay above the 21-day moving average, that's going to suggest to me weakness, as we're seeing in the Asbury 6, the market's vulnerability to more weakness. If we get through 24, which we view as a line of demarcation for the VIX, if we get above 24 in the VIX, I believe that would put some additional downside pressure on the U.S. broad market. Number 4, market breadth. Bullish extremes suggest a tactical market top. So what we have on this chart is a little bit over a year back on a daily chart in the S&P 500 up top. Then we have down underneath here, we have the percentage of NYSE composite stocks that are trading above the 40-day moving average. All of these red highlights here show when we got up to 71% here during that period. We touched it on November the 8th, and although that was an immediate top, really that was the end of this move. The January 4th move to new highs didn't hold, and that was the beginning of the bear market for this year. Notice again, we got close to it in March, the end of March. That was a tactical top. We got close to it again on August the 16th. That was another tactical top. Now, as of November the 10th, we've been hovering around it, and now we're starting to roll over. You can see this down below. That suggests if we are indeed still in a valid major downtrend, this is where it should resume. So this throws another chip on the scale, so to speak, for the bearish argument. We're still in a major downtrend. Our Asbury 6 has turned negative. Protection model has just turned to risk off after being risk on since October. So unless there's a major bullish trend change here, which I don't see right now because of the internal weakness recently exhibited by the Asbury 6, this is where that downtrend should re-engage. Finally, market sectors. The SEAF model favors healthcare. The SEAF model is our own in-house model. It stands for Sector ETF Asset Flows. And I built this model many years ago, and it basically tracks the asset flows moving around the 11 sector spiders, which together represent the S&P 500. So the last time that I was with you, we talked about the SEAF model was overweight XLE as of October the 10th. The SEAF model exited that trade on December the 5th after capturing a 15% rise and 3% of relative outperformance by XLE, or the energy sector, over the S&P 500. The other one, when I was with you last time, that was favored by SEAF was XLF, financials, as of October 31st. That idea was also exited by the model on December the 5th after capturing a 2% rise outright and 3% of relative outperformance versus the S&P 500. The current model, or the model's current signal, is in healthcare, and you can see that's because healthcare is showing a trend of strong asset flows coming into healthcare in 3 different time frames: in our trading time frame, our tactical time frame, and our strategic. That shows us that there's something going on here with money that is moving into the healthcare sector, and that money is that asset flow in is what happens before you get an actual price move and outperformance versus the S&P. So far, again, this is a pretty new trade here. Since 11/28, healthcare has already outperformed SPY by 3%, and it's risen outright also by about 3% since then. So we have our eyes on healthcare. Healthcare, by the way, would be a defensive play typically. So outperforming healthcare over the next several weeks or into the early part of next year would dovetail with a weakening S&P 500 as it's bumping against a major resistance level and weakening market internals according to the Asbury 6. So, a lot to cover today. There you have it. If you like our approach to markets and investing, I invite you to visit our website at asburyresearch.com to get more information about us. If you'd like to see more videos like this one, you can visit the Asbury Research channel on YouTube, and you can subscribe there. Thanks for watching. I won't see you, I guess, through the holidays. Probably the next time that I appear here for StockCharts is going to be in January. So thank you all for your interest. Thank you all for the kind comments that you've made about our research. Have a wonderful holidays with your family, and I will see you very soon, hopefully in early January. Thank you again.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.